Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Thursday, April 24th, 2025. S&P 500 currently sitting at 54.59. I'm David Zarling. I'm here with Ian McMillan on episode 250 of the Weekly Trend. Pretty wild.
It's a quarter of 1,000.
It is. Pretty nice round number.
Weeks talking about squiggly lines.
Yeah, 250 weeks of price action. Don't know if we thought when we started the podcast that it would carry this much traction, but here we are. And by some metrics, looking at over 3.5 million podcasts, we're in the top 2%. Never thought that was possible, but you're not in the top 2% of listened to podcasts without listeners. So really, it's the listeners we want to thank for tuning in and taking in our episodes on an almost weekly basis. So thank you for doing these with me, Ian. Of course, we've had Kevin on here several times. Does a great job when he's on. Also does a great job behind the scenes, making sure we get these out. Pretty humbling to experience. Nice round number, but we move forward. Anything you want to start with regarding the price action this week? And I realize we're recording this on a Thursday in order to accommodate some of our work schedules for tomorrow, Friday, April 25th. So we don't have weekly closing price action yet. But where would you like to start on things that you're looking at and seeing?
Yeah, S&P 54.80, 54.90, exactly where we were 2 Thursdays ago. So very little movement over the last 2 weeks, up days, down days. But the intermediate term trend remains unchanged as far as I'm concerned.
Yeah, no, I think it's fair. I think when we look at the fact that the past 9 days has been price action inside the price action on April 9th, that big 9 to 10% upside day percentage-wise, the fact that we're still inside of that, and today would be 10 if we close below 54.91 on futures and 54.56 on S&P.
That's crazy. And now it makes sense, right? I mean, were we up that day? 8, 9, 10% or something like that?
Right.
So yeah, 2 weeks, basically.
Yeah,
10
2
trading
weeks
days, 2 weeks.
2 weeks within the price range of 1 day. We've seen the VIX volatility index cool off.
And I wouldn't say it's like the tightest consolidation inside that candle.
Right.
Like if we had that candle and it was tighter price action, maybe staying in like the upper half or the upper third of that range.
Mm-hmm.
And not that beggars can be choosers on how markets bottom, if this even is a bottom or the bottom.
Wait, you don't know that it's a bottom?
There's a lot of strong opinions on there. Hard for me when you're below 200 day, which I guess all bottoms probably happen below 200 day.
Right.
So, yeah, building evidence, I guess.
Yeah, there's some things. I mean,
yeah,
there's some things. I mean, there's some places of relative strength out there. We have we have a potential of a Zweig breath thrust today or tomorrow. And
I've read that. I've read that many a times in my feed.
Yep. And the last time that happened was November 23. And it's as a reminder, Zweig breath thrust is called that not because Zweig is, it's a fun word, but it's developed by Martin Zweig. And it's really looking at market momentum. And it's looking at breadth from the following formula, basically looking at advancing issues plus declining issues on a 10-day moving average metric. And when that over a 10-day period, which we can look back to, April 11th approximately, over a 10-day period, that indicator going from below 40 to above 61.5. So really what that breadth indicator signifies is going from overwhelming negative breadth to overwhelming positive breadth. And it does have some strong characteristics when it does signal. I mean, it's going back to 1950, you have 6-month and 1-year returns positive 100% of the time, averaging 16% and 23%.
So 100% of the time, 1 year later?
6 months and 1 year later.
Wow.
So it could be something worth paying attention to. And, when we look at the data currently for that.
But can you get do you have a list of those dates?
Yes.
Is one of them October 2008?
No.
Okay.
One of them is March 18th, 2009, and we know the market actually bottomed on March 9th.
March 9th, yeah.
But it's got a pretty strong track record, and you have to be open to possibilities. It's also okay to say, wow, that's interesting if we recorded that breadth thrust without the close on April 9th. So all this price action not closing above the April 9th. Now, again, we're recording this before close on April 24th, a Thursday. We still have tomorrow.
So maybe some good accumulation.
Yeah, some good accumulation. I know you mentioned on our pre-recording notes that there are some individual charts out there that are showing some positive.
Yeah, there's some strong stuff. I guess as far as big names, you probably have to give it to Netflix right now, making new all-time highs again. We didn't get there yesterday, but we are today. Definitely a leader. Never went below a 200-day exposure to Netflix. Not a terrible thing. Trading at, I don't know, almost $1,100 a share. So probably won't be purchasing that in the ETF, but definitely it's a pretty strong chart.
But if you were to see a bottom develop, a Zweig breadth thrust would be a pretty good first step.
To be based on the data.
Yeah, it would be a really good first step to go from overwhelming negative breadth to overwhelming positive breadth with nothing but negative sentiment happening around this. We are above the volume weighted average price of tariff announcements but definitely not out of the woods yet, because overhead, right? We call that overhead resistance. We still have the gap down that took place from the tariff announcement. We still have the July 2024 level near 56.40, 56.50. We still have the polarity in the S&P that sits around 5,700. We have the 200-day moving average, which is currently at 57.54. So this area, and we covered this, you were in town for our education event for our clients, which was, I really appreciate you making the trip, and it was a nice event. Great. We do a breakfast, and we also do a cocktail hour, and we go through markets, we go through our process. It's something we like to provide to our clients and be transparent. And in that, there's quite simply a game plan. This 5,600 to 5,800 level on the S&P is a really big level to have to clear. So step one, great, get a Zweig breadth thrust. Then you have to see follow through that we clear through that 5,600 to 5,800 level, because you have all those different, whether it's the volume weighted average price from the all-time highs, which on futures is currently sitting at 56.18. You have the area of polarity. You've got a 200-day moving average. So time will tell. You've got step one, possibly. We could record that today or tomorrow. And then you have to clear through 5,600, 5,800. It's really that simple math. And I get it. There can be, our clients are familiar that we're de-risked, right? We're holding high levels of T-bills, treasury bills, and cash. If we clear that area back above a 200-day, we will be more than happy to participate.
Yeah, that is correct.
But definitely not out of the woods. I mean, we can use oil as an example. Looking at oil futures, we still can't get above $65, which was an important level going back a few years here.
Yeah, that really looks like a pretty clean retest from the underside. Again, anything can turn into a failed breakdown, but I mean, that's a clear, very well defined area there, $65. So likely continued lower prices at the pump.
Right. And trade weighted dollars, same thing. Below $100 on DXY. Yes. When you look at that, that's an area of polarity. If we can't get below or above, back above that. And I think we can talk about what we've talked about in the past, which is just dollar and stock correlation. I don't know that we get to say that's 100% of the time because, right, the dollar's 10% off its highs and stocks are also still down 10, 12%. So, and when I say stocks, I'm saying the S&P 500. We have seen strength out of international, and that is absolutely true. But we don't get to sit here and say, oh, the dollar is down. That just means everything's going to be good for stocks. That's just not the case.
Correct.
And that needs to reclaim 100 on that. You have the relationships like technology, XLK versus S&P, versus S&P have very clear horizontal levels that they're still below. And if those turn into false breakdowns, that would be further confirmation of the Zweig breadth thrust, or you get a breadth thrust. And if we're actually able to reclaim those necklines, that would be part of step 2.
Good point.
Financials, also a economically sensitive sector, trying to put in a false breakdown. We did
JP Morgan trying to get that relative chart to do something.
Right.
So close to, I mean, really multi-decade relative highs there.
Right.
87. That would be 37 years.
37
I know that
years.
I was born in 87.
Yeah. Right after the October crash, right?
Yes.
I think XLF reclaiming $47 is huge. We have that so far. Reclaiming its rising 200-day moving average, important. So if technology versus S&P can reclaim its horizontal level that it broke below, SMH or semiconductors versus S&P does the same thing. Financials confirm with a false breakdown. We do have the opportunity to surprise to the upside. It's there. The opportunity is there.
We do.
And this is the part of the process where, you know, people, when you are in protective mode at this time, people can get a serious sense of FOMO, or the fear of missing out. But you really have to have in your process and not just chase moves, because there's some really big overhead levels coming up here that it's okay to wait for confirmation. And we will happily jump back on the highway and put the cruise control on and be involved in this market if we can be back above a 200-day moving average, back above 5,800, back above these really important behavioral levels where sellers and buyers have interacted heavily in the past. We have to clear those first. It's great to get a Zweig breadth thrust if we get it, but we have to see confirmation of price following through in that regard, and that just takes patience.
Yeah, I agree. And if you look at where ADPV in particular went to cash March 17th, I mean, that is right on those July 2024 highs.
Right.
Like 56.80. Still below that level on the index itself. 200 days starting to roll over. So we'll see. But that the aircraft carrier is turning. Mm-hmm. Not to say we can't rip right through that. But
well, it's important to note
that the headwind's getting a little stronger.
Mm-hmm. And I would say that, you know, the news of the day, the narrative of the day is tariffs. I think we'd all agree on that.
Yep.
But I thought you did a good job highlighting for clients that many broad markets were down 8% even before tariff announcements were made. And then we sold off hard, and we're still below the tariff announcement level.
Yeah.
On something like the S&P 500. So that's important to keep in context that, yes, it's very easy to marry the tariff narrative to the price action and the pause of tariffs to the price action, but also being open to the fact that markets know more than any of us. And if we can't reclaim the levels we just talked about, the volume weighted average price from the high, all-time high, the 200-day moving average, the gap from the tariff announcement, that maybe, just maybe, there's something else. There's another narrative that we don't know yet. If we were to roll back over. Now we could be here 6 months from now, point back to episode 250 and say, hey, remember when we were talking, there was step 1, getting that Zweig breadth thrust, and then step 2, getting above this 5,600 to 5,800 area. And we will happily participate again. And that's called being adaptive. And you brought up ADPV, and I should highlight that supporter of this podcast, the Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. So we have this setup here. We've got a potential Zweig breadth thrust. I feel like I've said that 20 times now. We have the potential of these breakdowns becoming false breakdowns. And a couple other market environmental things that are noteworthy, at least in my opinion, that would be in the bullish camp, would be just the momentum factor holding up well. Whether you're looking at something like SPMO versus S&P, which is S&P momentum, or mid cap momentum versus mid caps, or small cap momentum versus small caps, those have held up really well. Those relative relationships are on the verge of going out at new highs.
Yeah.
And then on the flip side, what's interesting, and I'm cherry picking a little bit here, but I think our listeners know, and people who follow our work know, that it's not the earnings themselves that matter. It's the price reaction to earnings. Mm-hmm. And today's a 75% up day at this point, at about 11:30 Central Time on Thursday the 24th. So you have a green tape, so lots of stocks green, but those companies that reported earnings either last night or today, things like IBM, Pfizer, Procter & Gamble, Pepsi, Union Pacific, are all getting sold pretty hard in this green tape.
Really?
So that is something that kind of makes one sit up and take notice. Wait, we've got this breadth expansion, but we're selling earnings on that.
4-year lows for Pepsi.
So I don't know. I mean, time will tell.
What do you think about Bitcoin?
I think you said it well this week, that you have to give credit to Bitcoin's relative strength here.
I saw a good explanation, and again, I have no idea. I'd never thought about it this way. Maybe people with way bigger brains than me, but I do kind of agree with it. I saw this on Twitter that like Bitcoin finds itself between like gold and the NASDAQ 100.
Yeah, I think that's
like, as far as volatility, I think there's always been this debate on whether it's like the new age gold, the digital gold, whatever cool sticker you want to slap on it. But really impressed that it held. Obviously, it didn't remain in an uptrend like gold. And maybe this is more of a shorter term narrative, because in the past, we've definitely seen Bitcoin get hit when stocks get hit.
right.
Now, was gold ripping in those instances? No. Like in 2022, gold was down with stocks. Gold got hit in COVID. So definitely recently, those two periods haven't seen a rush to gold. Gold clearly in a strong uptrend over the last year. Really impressive move from gold. But yeah, I thought that was an interesting view on Bitcoin.
Yeah, I think that's a great take. I mean, I think, understanding the nuance that it has some risk on, risk off characteristics to it, some beta. Some like to think of it as a store of value like gold, it's digital gold. And speaking of gold, it's had quite the run. I mean, to the point, we haven't seen gold price this far from a 200-day moving average to the upside in quite some time. And when we get to this type of level, we're about 20% away from a 200-day moving average. Typically, you see a pause in here, whether we're talking about 2006, 2008, even more recently, 2020. You typically get into these. You're now in the top quintile of distribution data on distance away from a 200-day. I guess the way to say it would be, don't know if this is really a great spot to take on a new position gold.
No, definitely not. Of course, I can say visually, and visually it looks stretched, but I could find 1,000 examples throughout history where things like this keep going. Yeah, but from a risk reward standpoint, I get it on a relative basis, maybe. Absolute basis, really tough, very stretched when you look at some of that data out there.
So we talked crypto, some oil, talked gold. What are we seeing? How about international equities, right? Because they've had the strongest start to the year.
Spain, Greece, Poland. And when I say these, I'm referencing the ETFs, the US-based ETFs that track those countries. But even if you're looking at their domestic, like the DAX had a great recovery. You want to talk about V-bottom? The DAX looks like a potential V-bottom.
Right.
Now, there's a neckline up here around 22,000, 22,300 that maybe has to go get touched or something. But that was the quickest recovery. Right? And you could look at European financials back to all-time highs.
Yeah.
Massive V-bottom. Are we creating a range? Is this are we just cruising through this? I have no idea. But they were the relative winners going into this correction, and they look to be emerging as the relative winners as well.
Right. And that would still be something if all this tariff narrative, and here you see international do well.
Wouldn't that be something?
Yeah, wouldn't necessarily fit the narrative, would it?
But yeah, lots and lots. I mean, when we go through the workbooks now, you've got, obviously, Argentina is still very strong. Pretty much even Brazil has found its way back above a relative 200-day. Mexico looks good. Chile looks good. A lot of European and there's some decent, our clients be familiar with the loaf of bread analogy, and some pretty good ways to slice and dice foreign equities out there. And gotta be honest, they all look pretty solid on a relative basis. Italy,
right?
Italy's out to 5-year relative highs. So,
and that's the stuff you want to pay attention to when you have, market weakness. What are the things that are holding up well? And could you see an environment where clients have a larger exposure to international equities here than they have in the past 9 years? Absolutely. And got to see confirmation. You brought up European financials. They really need to hold this breakout to all-time highs. And so far, so good. And I think the other thing the market as a whole going for it is when you look at XLG versus the S&P, so the top 50 stocks in the S&P, still holding up okay, trying to build a range on top of the relative highs from 2008. But if that fails, it's going to be really hard if the top 50 stocks aren't performing well. Like if they're underperforming,
math, right?
Yeah, it's just going to be really hard. Because
what do you think? Like an Apple? I mean, let's take a look at an Apple. You're going to need Apple to participate in this. I'm not, again, like we like to say, it doesn't have to lead. It's definitely going to help if it leads. It's still the largest weighting. Yeah, I look at that chart, and if you wanted I think most technicians, if you've done this for an extended period of time, probably give you an opinion on something within, 10 seconds. And when I look at Apple, and you made me buy 10 things today, it wouldn't be on the list.
Right. Yeah, still a lot of work to do. And you look at like Mags.
Yes.
The
looking at Mags this morning.
The Magnificent Seven, definitely not out of the woods.
No.
So if we're gonna see the Magnificent Seven not really participate and not carry a bucket, and XLG versus S&P breaks down, you're going to see a really muted response from a cap-weighted index like the S&P 500, and you could see things like value and financials and international, because it comes up to composition of these indices.
Mm-hmm.
S&P's 30-some% growth technology. Internationally, it's more 30% financials value.
And yeah, if you think tech's going to underperform for the next, few months to few years, then yeah, you're probably hopping out of the S&P.
Right. You're definitely tilting more towards international. And that might be hard for some people to, hop on that train, because basically since 2008, international's underperformed US growth. That's just been a fact. And that doesn't have to be the case for the next 10 years. What about bonds?
Bonds. Always a big question, always a big topic. Bonds. So let's look at long-term, most sensitive to interest rates, holding their own. We're at the low end here.
Right.
Which means rates are at the high end of where they've been over the last 18 months. So yeah, like a 30-year treasury basically sitting up. We're at 4.78 now, but at the higher end of this range. So we'll see. Definitely not a downtrend. One could make an argument for an uptrend, but sideways. Eventually we'll get a direction. It'll probably be pretty swift, but I have no idea which direction that is. I guess higher, continuation of the current trend.
Right.
But we'll see.
We will. Patience is the key here, not chasing. It's very obvious that, long duration bonds, treasuries, even the broader bond complex aren't a buoy to the 60-40 portfolio. Even just looking at the price action of something like TLT, still lower from where tariff announcements were made. You're not seeing it buoy stocks. They moved in the same direction. And let's not forget that, TLT is still 48% drawdown from August of 2020.
Mm-hmm. Yeah.
So not really representing that risk parity trade, that offsetting portion of the portfolio. Our clients are aware that we don't hold a lot of long duration treasuries because of that trend. And so you're right, like really treasuries, long duration treasuries are guilty until proven innocent. And it's fair to say US market wise, those stocks are guilty until proven innocent as well. Until we clear 5,600 to 5,800, that's really where, if you're following at home, that's the chart you should be looking at. And it's awesome that we have a Zweig breadth thrust on our hands. That is step one. Step two would have to be clearing this 5,600 to 5,800, and then looking for areas that are holding up relatively well. Financials, communication services, some of these international areas that you highlighted, those are the things we want to be paying attention to for sure.
Agreed.
And, I think with the breadth thrust confirmation, if we get it, I think we have some caveats if price is still within the April 9th price level. And I think David Settle, a charter market technician that we highly respect, last time we recorded one in October and November 23, we were above important moving averages, and the S&P is still below the 30-day moving average, still below a point of control on a 1-year volume profile. And so some of these things sometimes have to be taken with a grain of salt, but it would be a really good step one if we recorded a breadth thrust and then cleared some of these important areas. So we're definitely not out of the woods, but maybe there's some, can I say green shoots? Is that an overused term?
Oh my gosh. I think that's what they say, right? Green shoots?
Yeah.
But yeah, we got to have the horizontal price confirmation, horizontal level price confirmation. That's the only way. I mean, that's just really that's the final piece.
Yeah, we have.
You actually got to move higher.
All technical analysis is the study of supply and demand and the dynamics thereof using charts. And it's very obvious when looking at price charts that sellers took control of this market below 5,800, 5,600. It would make sense to prove that there's enough buying capacity, enough demand, chew through those sellers and move higher. That's really what we're waiting for, is information of that area, which includes the tariff gap, the all-time high volume weighted average price, the 200-day moving average, the polarity at 57.50. If we can clear that, now it turns into a market that's innocent until proven guilty. But we have to wait. We have to wait. Anything else, Ian, that we should cover for our listeners before we shut this one down?
I don't have anything.
Okay. Well, I appreciate you doing this, for the past 250 episodes, and special thank you to Kevin too for all his work helping get these out the door. There's a fair amount of work that goes into these, and we know our listeners appreciate it based on where we rank, but we hope that you guys that are listening continue to share this with others, continue to give us high rankings on your platform of choice. That means a lot to us. And with that, we'll wait for the market to confirm whether we can get above 56 to 5,800, whether that's in the next few weeks or next few months, we don't know, but we appreciate you guys listening.
Have a great weekend, everyone.